Hi, I am Ogjan Ag. Iran's supreme leader Ayatollah Ali Khamenei is dead. The United States and Israel launched Operation Epic Fury on Friday, February 28th. Senior Iranian commanders are gone. The Tehran compound was hit. And now, as I record this on Sunday, March 1st, 2026, Iran is firing missiles at Israel and Gulf states in a widening war that nobody outside of a classified briefing room saw coming in this form, at this speed, at this scale. Markets are closed right now. You have approximately 18 hours. And when silver opens Monday morning, March 2nd, 2026, you are going to witness something that has never happened before in precious metals history. Not because of one event, not because of one variable, but because three separate catastrophic forces are converging on the exact same moment in time. A Middle East war that just eliminated the most powerful figure in the region. A COMEX delivery crisis that already broke the exchange badly enough that CME halted trading midweek. And a silver market sitting at an all-time low in registered inventory with 10,526 contracts screaming for physical delivery that may not exist. I am going to walk you through exactly what happened this week. I am going to show you what COMEX did with trading that nobody in mainstream media is explaining properly. I am going to connect the Iran war to the physical silver crisis in a way that should make every single person watching this sit completely still for the next several minutes. And I am going to give you the price levels on Monday that will tell you everything you need to know about whether we are about to see the most violent silver surge in modern market history, or whether this market has one more gut punch left to deliver before the real move starts. But first, let me paint the picture of the absolute war zone we just lived through this week. Because if you only watched the price and missed everything underneath it, you missed the entire story. Tuesday, February 24th, China reopens after Chinese Lunar New Year. COMEX registered silver inventory reads 86.13 million ounces. For context, that is down from 167.7 million ounces in October 2025. That is a 48.6% drain in 4 months, and March open interest is still massive. The paper market has been writing obligations against metal that is physically draining out of the system every single day. Wednesday, February 25th, CME Group halts silver trading. Not slows it, not pauses it briefly, halts it. And here is the number you need to understand immediately. While the CME was halted, 31,828 silver contracts traded anyway. Let me be precise about what that means. While the exchange that is supposed to be the price discovery mechanism for silver in the United States was not operating normally, nearly 32,000 contracts representing 159 million ounces of silver changed hands. That is almost double the annual mine supply of the entire United States in a single session during a trading halt. The CME Group has never fully explained this. Mainstream financial media has barely covered it, but 31,828 contracts during a halt is not a technical glitch. That is a system under an extraordinary level of stress doing things it is not supposed to be capable of doing. Thursday, February 26th. Gold pushes through $5,200 for the first time since the January highs. Silver closes at $89.90. The gold-to-silver ratio compresses to 58-1, down from 64.5 in early February. The physical market is screaming. Lease rates are spiking. Silver is still trading in backwardation, meaning the spot price is above the futures price, a signal that tells you physical buyers want metal now and they are willing to pay more for immediate delivery than they are for promises of future delivery. That only happens in a shortage. Friday, February 27th. First notice day for March COMEX silver. This is the moment that everyone in this community has been counting down to for 6 weeks, and the number that came in should have stopped every financial journalist in their tracks. 10,126 contracts were standing for March delivery. That is 52.63 million ounces of silver being demanded from COMEX vaults right now, against 86.13 million ounces of registered inventory. The delivery math is 61% of the entire registered vault being demanded in a single delivery cycle, and this comes right after February 2026 delivered 5,036 contracts, 25.18 million ounces. The market is accelerating. Not slowing, not rolling, accelerating. Physical demand for actual silver is increasing month over month, while inventory decreases month over month. And then Friday night, February 28th, at 11:47 p.m. Eastern Time, the United States and Israel launch Operation Epic Fury against Iran. Ayatollah Ali Khamenei, the supreme leader of Iran, 86 years old, the man who has directed Iran's nuclear program and proxy network for more than 3 decades, is killed in a direct strike on his Tehran compound. Senior commanders are killed, multiple strategic facilities are hit, and within hours, Iran fires ballistic missiles at Israel and Gulf states. The U.S. confirms 3 soldiers killed, several injured. Trump warns Iran not to escalate further. Iran says the retaliation has only begun. As of Sunday evening, March 1, 2026, this war is active, it is escalating, and it is happening in the heart of the world's most important oil-producing region, while gold and silver are already in the middle of a structural physical delivery crisis that nobody in mainstream finance is prepared to explain honestly. I want you to understand the collision that is happening right now, because these are not 2 separate stories. These are 2 forces that feed each other. The Iran war does not just create safe haven demand for gold and silver in the abstract way that geopolitical tension normally does. The Iran war directly threatens the Strait of Hormuz. Iran has already signaled its willingness to use the strait as a weapon of economic warfare. Roughly 20% of global oil supply passes through that choke point. If it closes even partially, even for a week, energy prices explode. Inflation data in April, May, and June will be catastrophic. Federal Reserve rate cuts get pushed back, which normally would be bearish for metals. But when inflation is driven not by excess demand but by supply disruption, by war, by energy shock, the traditional framework breaks. Central banks cannot fight oil-driven inflation with rate hikes without crushing their own economies. And when the market realizes that, real assets, gold, silver, hard things you can hold, become the only rational store of value. Furthermore, Iran controls a significant portion of the global supply chain for strategic metals, not silver directly in the same way China does, but the disruption rippling through oil, through shipping insurance, through counterparty risk across the Middle East financial system creates a flight to safety that is not incremental. It is violent. Reuters reported Sunday that there will be extra haven demand for gold that could see prices rise to $5,500 again, possibly to a new record high above January's peak. Goldman Sachs is maintaining its $5,400 gold year-end target, with analysts noting significant upside risk. J.P. Morgan has raised its long-term gold floor to $4,500 while keeping a $6,300 year-end target. And Bank of America, the bank that most people dismissed when they first said it, is still projecting silver at $309 in 2026. Now they look less crazy by the hour. The Polymarket prediction market as of Sunday is showing a 79% probability that silver opens up on Monday, March 2nd, not up a little, just up. That is the crowdsourced wisdom of real money being deployed right now, saying the overwhelming probability is a gap up open tomorrow morning. Here is what a gap up into this COMEX delivery environment actually means, and this is where it gets genuinely terrifying for anyone holding short positions right now. When silver gaps up on Monday morning, the people who are short silver futures through the March contract are immediately deeper underwater. They have a choice. Post additional margin or close the position. Closing the position means buying silver. Buying silver in a market that already gapped higher, that buying pushes the price higher still, which forces more margin calls, which forces more buying. This is the cascade. This is what a short squeeze actually looks like from the inside. And the conditions for it have never been more perfectly assembled in silver market history. 10,126 contracts demanding 52.63 million ounces of physical delivery. 86.13 million ounces registered. 74.38 million ounces already delivered in March. The remaining cushion in that vault, after accounting for what has already been demanded, is thinning by the day. COMEX registered silver is at an all-time low in this cycle. May 2026 open interest is already sitting at 375 million ounces. That means the moment March delivery clears or attempts to clear, the April and May squeeze setup is already being assembled in real time. The system is not getting more stable. It is getting less stable with every single day. Now let me give you 3 price levels that matter on Monday. Write these down, screenshot this, because Monday's first 30 minutes are going to tell you everything about the next 3 weeks. Level 1, $88 to $89 support zone. Silver closed at $89.90 on Friday before the Iran news broke overnight. If silver opens Monday and pulls back toward $88, that is not panic. That is profit-taking from Friday's close running into a gap up that partially fills. If silver bounces hard off $88 to $89 within the first 15 minutes of trading, that tells you institutional buyers are defending this level aggressively. They bought on Friday knowing the weekend carried geopolitical risk, and they are not letting go. That is the most bullish signal you can see on Monday morning. It means the floor is being defended with serious capital. Level 2, $93 to $95 resistance zone. This is where the January highs created overhead supply. Traders who bought in January and are still underwater will be looking to sell at break even. If silver gaps up to $93 on Monday on the Iran news and immediately gets rejected back below $91, that is a warning sign. It means the overhead supply is overwhelming the safe haven demand, and we need to consolidate before making another run. If silver pushes through $93 and holds above it for more than 30 minutes, we are looking at a full-on breakout, targeting the $100 level that Bank of America has been projecting for months. Level 3, $100 psychological barrier. If silver pushes through $100 on Monday, on a combination of COMEX delivery pressure, Iran war safe haven demand, and the short squeeze cascade, that number changes the story for every retail investor who has been sitting on the sidelines. $100 silver is the headline that puts this on the front page of the Wall Street Journal. It is the number that makes your neighbors ask what silver is. It is the number that brings in the next wave of buyers who create the momentum that takes us toward the Bank of America $309 target. I want you to understand something that almost nobody is talking about today. And it ties the Iran story directly to the silver shortage in a way that should completely reframe how you see this market. China implemented silver export restrictions on January 1, 2026. Only companies with 80 or more tons of annual refining capacity can export. That locked approximately 60 to 70% of global refined silver output inside Chinese borders. Now add Iran to the equation. Iran has historically been a key transit and financial corridor for metals moving between Central Asia, the Middle East, and Western markets. The war does not just create safe haven demand. The war disrupts the already fragile physical silver supply chain that was already under maximum stress. Shipping insurance for vessels operating near the Strait of Hormuz is spiking. Marine insurers pulled back from Iranian routes immediately after the strikes. Supply chains that were already stretched by China's restrictions are now being hit by geopolitical disruption in a second major node simultaneously. Physical silver supply cannot respond to demand in real time. You cannot build a new silver mine in 6 months. You cannot unlock Chinese exports with a press conference, and you cannot stabilize the Middle East in a week. The structural deficit that the Silver Institute confirmed is in its 6th consecutive year is not an abstraction. It is the reason that 10,526 contracts are standing for March delivery right now instead of rolling forward. Industrial users need silver. They are not speculating. They are not momentum traders. They are solar panel manufacturers, defense contractors, semiconductor producers, AI data center builders. They need physical metal. And right now, with China restricting exports, with COMEX draining, with the Middle East on fire, the supply pipeline is under simultaneous assault from 3 separate directions at once. Let me talk about what the CME trading halt actually means, because I do not want this to get lost. Exchanges halt trading in 2 scenarios. 1. Price moves are so violent that circuit breakers trigger. 2. The underlying technical or contractual mechanics of the market are at risk of breaking. The CME did not fully explain the nature of last Wednesday's halt. They did not explain how 31,128 contracts were able to trade during it. They did not explain whether those trades were official, unofficial, or retroactively ratified. What they did explain, implicitly by halting in the first place, is that something in the silver market last week was operating outside of normal parameters. That is the polished institutional way of saying the system was being pushed to its limits. And that was before Operation Epic Fury. That was before Iran's supreme leader was killed. That was before Iran launched retaliatory missiles at Israel and Gulf states. That was before Sunday's gap-up setup. The CME halted silver trading during a delivery crisis in normal market conditions. What does Monday look like with all of this added on top? Here is the unresolved tension that every silver investor needs to sit with tonight. The COMEX delivery math is not resolved. 10,526 contracts demanding 52.63 million ounces, 86.13 million ounces registered. The vault is not being replenished at anywhere near the rate it is being drained. If even half of the remaining open interest in May 2026 stands for delivery, COMEX registered silver does not exist in sufficient quantity to honor it. At some point, one of 3 things happens. Either new physical silver arrives from somewhere to replenish registered inventory, which requires either convincing China to reverse its export restrictions, which is geopolitically impossible right now, or opening new mines fast enough to matter, which is operationally impossible, or COMEX changes its delivery rules, raises cash settlement allowances, or force majeure's physical settlement, which is the functional equivalent of a default that they will call something else, or the price of silver goes high enough that the people currently standing for delivery decide to cash out at a premium rather than take physical, which requires the price to move dramatically higher from where it is today. There is no fourth option. One of these three things happens. And the Iran war just took the first option off the table entirely for the foreseeable future, because supply chain disruptions compound on top of supply chain disruptions. The second option, rule changes and forced cash settlement, is what they will try before admitting the third option. But rule changes in a market under stress create panic. If CME announces that March delivery will be partially cash settled, the May open interest holders will immediately stand for delivery before the same thing happens to them. It accelerates the very crisis it is trying to contain. The third option, price going high enough that holders sell their delivery positions, is actually the cleanest resolution. It is the market doing what markets are supposed to do, price the scarcity until demand backs off. The question is where that price is. When physical silver is this scarce, when the supply chain is this disrupted, when geopolitical risk is adding safe haven demand on top of structural demand, the price that clears the market is not $90. It might not be $100. It might be the number that Bank of America put on paper months ago that everyone laughed at. The people who are not laughing are the analysts who saw 10,526 contracts standing for delivery against 86 million ounces of registered inventory, and then watched Iran get struck on Friday night. For long-term physical holders, and that is the core of this community, tonight is not a crisis. Tonight is confirmation. Every month you held, every dip you stacked through, every margin call panic you watched from the sidelines while staying patient, this is what that patience was building toward. You do not need to do anything tonight except understand that the thesis you believed in, the structural deficit, the COMEX drain, the China restrictions, the industrial demand, the central bank buying, all of it just got a geopolitical accelerant poured directly on it. For traders looking at Monday, here is the framework. In the first 15 minutes of trading, 9:30 to 9:45 a.m. Eastern, watch how the gap holds. If silver gaps to $93 or $94, and the volume in the first 15 minutes is above 30,000 contracts, that is institutional positioning, not retail FOMO. If volume is thin despite the gap, watch for a fill back toward $89 to $90. If silver pushes above $95 in the first hour with sustained volume, that is the confirmation that the Iran war premium is being taken seriously by the people with real capital. That is your signal that we are in price discovery mode and the targets are $100 and above. If silver gaps up and immediately reverses hard below $88, that is the market saying the geopolitical premium is being treated as temporary and the delivery crisis alone is not enough to sustain the move. In that scenario, wait for the $85 to $86 level before any positioning decisions. Watch gold closely. If gold is pushing toward $5,300 or $5,400 Monday morning and silver is lagging, that divergence is a warning. Silver should be outperforming gold in a delivery-driven squeeze. If gold is doing all the heavy lifting and silver is grinding, the COMEX mechanics are suppressing the silver move, and it will eventually break higher, but not on Monday's open. If silver is outperforming gold, meaning the ratio is compressing below 57 to 1, that is the squeeze operating as expected. That is the signal that physical delivery demand is overwhelming paper selling pressure. Watch the COMEX registered inventory update that comes out Monday evening around 9:30 p.m. Eastern. If it shows continued draining from the weekend, we are getting closer to the mathematical breaking point, faster than even the most aggressive projections suggested. I want to close with something that transcends the technical analysis and the geopolitical news, because the biggest picture here is one that most people are only just beginning to understand. We are watching, in real time, the transition from a world where paper markets set the price of silver to a world where physical markets set it. For decades, the COMEX was the authority. Whatever price printed on the futures screen was the price. Physical buyers and sellers organized themselves around that number. Premiums existed, but they were small, predictable, and largely irrelevant to the big picture. That world is ending. When 31,128 contracts trade during a CME halt. When 10,526 contracts demand physical delivery in a single month. When COMEX registered inventory drops 48% in 4 months. When China locks down its refined silver supply. When Iran's supreme leader is killed and missiles fly over the Middle East, over the same weekend that COMEX first notice day results hit the tape. The paper market is losing its ability to tell you what silver is worth. The physical market, the premiums at dealers, the Shanghai premium, the lease rates, the delivery demand, that is where truth is being spoken now. And right now that truth is saying that silver at $90 is underpriced, that the delivery system is under maximum stress, and that Monday's open is going to be one of the most consequential single sessions in this market's modern history. Do your own due diligence. I am not your financial advisor. I am showing you the data because the data is undeniable. The timing is undeniable, and the convergence of forces happening right now is unlike anything this market has seen. The war is real. The delivery crisis is real. The COMEX halt was real. The 10,526 contracts are real. The 86.13 million ounces are real. The 74.38 million ounces already delivered are real. And Monday morning's open is going to be very, very real. Stay sharp. Watch the 3 levels. Watch the volume in the first 15 minutes. Watch gold. Watch the COMEX inventory update Monday night. One of these sessions becomes the chapter in the history book. I think Monday, March 2nd, 2026 is that session. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly. OG out.